Some of the richest Americans pay little to no money in taxes. We've all heard of President Donald Trump paying $0 in taxes, even though he's one of the richest people in the world. And Warren Buffett, who's one of the most successful investors of all time, talks about how he pays a lower tax rate than his secretary. And even if you move beyond the famous people, what you'll see is that rich people in general pay a lower tax rate than regular people. And you want to know the craziest part? This is 100% legal. How do I know? Well, two reasons. For one, if it was not legal, all of these people would be in jail. And the second way that I know is because I've spent a lot of time studying the federal income tax code. And what I can tell you as an attorney, who is not your attorney, is that while the federal income tax code is over 2,000 pages long in this super small font, it really only tells you three things. Number one, it tells you how to categorize your gross income. Second, it tells you what deductions you can take from your gross income, which brings you to your taxable income. And then it tells you what is the tax rate on your taxable income. That's all you get from this 2,000 pages. And then once you understand that, either you're going to have a big tax bill or a small tax bill. See, what rich people are always trying to figure out is, for one, how can I have little to no taxable income? And second, if I do have any taxable income, how can I have the lowest tax rate possible on this taxable income? There are four main ways that rich people do this. These are things that you can start doing right now too, but I do have to advise you that before you make any changes to your financial situation or your taxes, make sure you talk to a professional, an attorney, an accountant, somebody that can make sure that you're doing it right, because you don't want to run into issues or red flags with the IRS, because that could end you up in a lot of trouble. The first thing that rich people do is to change the category of income that they get, because not all income is taxed the same. Now, everything that I discussed in this video is going to build on top of one another, so if you're serious about trying to see how you can lower your tax bill, make sure you watch this video until the end. If you made $100,000 and you went to an accountant and you asked them, what is the tax rate going to be on $100,000 worth of income, the first question that they're going to ask you is, how did you make this money? Because if you made this $100,000 from your job, you're going to have one tax rate. If you made this $100,000 from your stock market investments, it's going to have a completely different tax bill. And if you made this $100,000 from your real estate investments, it's going to have a different tax bill. If you go to work every single day and you get paid a paycheck as a W-2 employee, this is called ordinary, otherwise known as earned income. If you sold a stock and you made a $100,000 profit and you own the stock for longer than a year, this is called portfolio income, and you pay long-term capital gains. If you made $100,000 in cash flow from your real estate investments, this is called passive income in the eyes of the IRS. Do you want to know which of these three different types of income has the highest tax rates, meaning the highest tax brackets, and the lowest deductions? This one right here, your ordinary income. The money you make from your job. The money you make from what you do comes with the highest tax rates and the lowest tax deductions. The money you make from what you own comes with lower tax rates, and it also comes with higher tax deductions. So the first thing that every wealthy person tries to do, which is something that anybody can do, is they work to recategorize their income. They don't just work for this ordinary income, they invest their money into assets. That way they can earn this type of income. Portfolio income is when you own an investment and you sell it for a profit. This is like your stock market investment income, assuming you own your investments for longer than a year. And your passive income is things like rental checks with real estate properties. This is a different type of investment income, and it comes with its own set of tax deductions. So wealthy people are working to move their income from here to here because this comes with bigger tax breaks, not to mention the fact that when you own an asset, it also requires less time than going to work every single day. So if we come back to this tax chart, what we just talked about is changing your tax rate, because now when you recategorize your income, you have the ability to pay a lower tax rate legally. The second thing that wealthy people do is they lower their taxable income. So the question here is, how do you lower your taxable income? Because you're not taxed on your gross income, you're taxed on your taxable income. This is the gross income minus all of your deductions. This is what your taxable income is, and this is where it pays to have a good accountant on your side, because a good accountant's job is to help you find the most amount of deductions and write-offs possible. That way you have the lowest taxable income possible, because when you have the lowest taxable income, that means you're going to have a lower tax rate as well. Now, for the majority of people who work a job, if you were a W-2 employee, the way that it works for you is like this. You make money from your job, then you might get the standard deduction, which is what the IRS offers to everybody. And then after the standard deduction, you pay your taxes. And then this is the money that you have left over to go out and spend. This is the money that you can use to buy a car, to buy a home, to go out on vacation. This is the money that you have to do that, your post-tax income. But if you own a business, this could be a real estate investment business, this could be a business that you created, this could be a business that you bought. Now this is completely flipped. Now the way that it works is you make money from your business, then you pay your expenses right here, and then you pay taxes on whatever is left. Because now these expenses are deductions that you can take against your gross income, which is why you have a much slower tax liability, a lower taxable income, because you're paying for your expenses first. Now the question is, what can these expenses be? Well, these expenses have to be used inside of your business to help grow your business, but this again is where the help of an accountant is going to become so important. That way you can classify the right expenses, that way you can use as many expenses and deductions as possible. I own a business. I need a laptop to run my business. So my laptop was an expense that I get to deduct from my income before paying taxes. I need a phone for my business, so I deducted my iPhone from my income. I had to go to San Diego last year, I had to go to Manhattan last year. I spent about 2 months in San Diego and about a month and a half in Manhattan last year. Both of those were expenses. I got to expense my travel, my flight, my Airbnb, my meals. All these things were expenses that I got to deduct from my income before my taxable income. Now, if I didn't own a business and I wanted to go to Manhattan, well, now I have to spend that money with my post-tax income. I make money, I pay taxes, and then whatever's left I have to use to fly to Manhattan. If I wanted to go to San Diego, the same thing. If I wanted to buy a cell phone, same thing. If I wanted to buy a laptop, same thing. Here, if I needed to buy a truck for my business, if it classifies under the right exemptions, because there are deductions out there right now that will allow you to deduct the value of a heavy vehicle against your income. So if I went out and bought a $150,000 G-Wagon, I could deduct most of the value of the G-Wagon against my income. Now again, I have to justify that I'm using it in my business, but this is where now clever accounting comes into play. Like last year, my accountant kept telling me to buy a G-Wagon. Why a G-Wagon? Because he said that we could justify that if I bought a G-Wagon, he could say to the IRS, look, Jaspreet is an influencer. He needs to maintain his image as an influencer. How can he do that? Well, he can buy a G-Wagon, and now this G-Wagon is a tax deduction for him. Now, did I buy a G-Wagon? No, because for me, I don't want to go out and just spend my money to spend it, not to pay money in taxes. I'd rather pay a little bit of money in taxes and have more money at the end of the year rather than go out and buy something that I don't need. But this is where fancy accounting can come into play if you have a good accountant, because now you can use a tax code which is written by the IRS. And now you can use the code to your advantage, but you have to understand how it works. Now, I am not an expert in the tax code, but I have hired an expert in the tax code. I have hired an accountant whose sole job is to study the tax code, study the deductions, stay up to date on what's happening, and then tell me what I can do in terms of tax planning so I know how to spend my money and different ways for me to now use my money. That way I can pay less money in taxes legally. Remember this, it's not how much money you make that matters, it's how much money you keep. If a doctor, a stock market investor, and a business owner all made $1 million in a year, they're not all going to keep the same amount of money after taxes. The doctor might be paying 40 to 50% of that money in taxes because that's ordinary income and you have the least deductions. Now, the amount of money you're going to actually pay is going to depend on what state that you live in, what state taxes you have, but you might have to pay $400,000 to $500,000 that year in taxes, meaning you're left with $500,000 to $600,000 worth of your income. Still a lot of money, but nowhere near the $1 million that you earned. The stock market investor earned portfolio income, which means you get the benefit of a lower tax rate, which means the top tax rate for you is 20%, meaning you're going to be paying about $200,000 in taxes. You still made $1 million, but you get to keep $800,000 out of that million. And third, now you have the business owner who made $1 million. Now, if the business owner made $1 million but had no other deductions, that was their profit, that's their taxable income, they're going to pay the same tax rate as the doctor, that $400,000 to $500,000 in taxes. However, you have the ability now to harvest debt that the doctor couldn't do. And this means that you'll have the ability to keep money in your bank account and not have to pay taxes on all that money. Now, there are two ways for you to use debt as a business owner to earn money and not pay any money in taxes legally. But I gotta give you a little bit of a disclaimer here, because anytime you use debt, you increase the risk. You increase the risk of you failing, you increase the amount of expenses that you have, because no matter what happens, even if your business starts to struggle, you still gotta make your debt payments. So anytime you increase the debt, you increase the risk and you increase the chance of failure. So don't do this for the purpose of just saving money in taxes unless you really understand the risk, unless you understand the issues that could happen with debt, and unless you fully understand that, don't use debt. I personally don't do these strategies because for me, I don't want to go out and just take on debt to save money in taxes. If I was to use debt, I want to use it strategically to help grow the business. So just understand that the debt increases risk. Option number one is to follow the Elon method, which is now where you don't take out an income from your business, but rather you use debt to finance your lifestyle. So one of the things that Elon made really popular was the fact that he doesn't earn an income, a salary income from Tesla. He gets paid in stock options. What that means is he owns a lot of Tesla stock, billions and billions of dollars worth of Tesla stock, but this isn't cash in his bank account. So now if he wanted to actually receive any cash, he had two options. He could, one, go out and sell this Tesla stock, but as soon as he sold this Tesla stock, he'd have a huge taxable income because he created Tesla. So his basis in the Tesla stock is very low. So if he sold his Tesla stock for a huge profit, which is what he'd be doing, he'd have a big taxable income. Option number two is he can refinance out of his Tesla stock. He can use debt against the value of his Tesla stock and use his debt to pay for his lifestyle because debt isn't taxable. It's easier to understand this with bigger numbers, so let me just explain what this means. Let's assume now that you own a business making $1 million a year. If your business is making $1 million a year, it might be worth somewhere between $10 million and $20 million, 10 to 20 times multiple, depending on what industry your business is and what your business does. So your business is worth $10 to $20 million. Now the question is, how can you realize the value of this business and use this value of your business without actually selling your business? Because if you sold your business today for $10 to $20 million, you're going to have a big tax bill. But if you just took out debt against the value of your business, now this debt isn't taxable and you also still own your business. So if you go to the bank and you say, hey bank, I have a business worth $10 million. Would you be willing to loan me $1 million? Most banks, assuming you go to the right one, are gonna say yes. So now you go to the bank and you take out a $1 million loan because the bank wants to give you money because they see the value of your business. And if you don't pay your loan, well, now the bank will get a $10 to $20 million business. So most banks want this deal because if you fail, they're gonna win big time. So this is why banks would be willing to loan you $1 million. Now you have $1 million in your pocket, tax-free. Because now if you were to go and refinance your home, that debt that you get that isn't taxable, debt isn't taxable. So you're just pulling cash out, tax-free with debt, and now you have $1 million to spend. Now you can use this $1 million to buy a home, you can buy a car, you can buy food, and you can live your life, and you don't have to pay any money in taxes. Now you might be saying, but now how are you going to pay back this debt? Because everybody has to pay back this debt, right? Well, the question now is, what are you going to do with your business? Because if you can keep growing your business, maybe in a few years your business isn't worth 10 to 20 million, it's worth 50 to 60 million. Now what you can do is you can say, hey bank, how about you give me another $5 million now because my business is worth 5 times more. Now you have more money, you use this more debt to pay back this debt, and you start to play this debt game where you pay back your old debt with new debt. Now if you keep doing this until you die, you win. But the risk here is what happens if your business fails? What happens if your business doesn't grow? What happens now if you run into financial struggles? You can start to see where the risk is, but this is a way now for you to use debt as a way to finance your lifestyle without having to pay any money in taxes because you're not taking any money out from your business. You're using debt to finance whatever you're doing using the value of your business as security. The value of your business is the collateral. And you're using that to get a loan, which is why now this loan is tax-free. You use this money to live your life, but you only have to pay taxes if you actually pull money out, if you have taxable income, and debt is not taxable income. The second way to use debt would be to buy bigger deductions. Let me give you an example. So let's assume now that you own a business and this business makes $100,000 of profit this year. This would be your taxable income, assuming that you have no other deductions. But let's assume now that you want to go out and you want to buy that G-Wagon and you want to be able to deduct this G-Wagon against your income. Well, if a G-Wagon costs, let's just say $100,000, well, that means you're going to be out all of your cash if you buy the G-Wagon with cash. Well, option number two is you put down $20,000 and now you finance the other $80,000. If you were to finance the other $80,000, now you only put down 20 grand, which means you still have 80 grand in your bank account. And now you have a G-Wagon, but now you also get the tax write-off for the entire G-Wagon. Now let's assume that you use 80% of the G-Wagon for your business and you use 20% of the G-Wagon for your personal life. Meaning sometimes you take this G-Wagon and you go to the movies, you hang out with your friends, you do other things. So the G-Wagon is primarily business use and some of it is for your personal life. Now, what you get is an 80% deduction on the value of the G-Wagon against your taxable income. 80% of the $100,000 G-Wagon is an $80,000 deduction against your taxable income. So now you get an $80,000 deduction against your $100,000 income, meaning you only have $20,000 worth of taxable income, but you have $80,000 in your bank account. Remember, you didn't buy this G-Wagon with the $100,000 in your bank account. You bought this with a loan. You used debt. So you put down $20,000, which is why you have 80 grand in your bank account. You use the other $80,000 from the bank's money to buy the G-Wagon, but you still get to deduct 80% of the value of the G-Wagon, or $80,000, against your income. But this is where things really get fun, because now what happens if you buy something for your business, but you don't have enough income to support the value of your deduction? Let me show you what I mean. So let's assume that you want to buy a G-Wagon, but you don't make $100,000 a year. You only made $25,000 a year. Now, I'm not going to recommend anybody do this. I'm just talking about how the taxes work, and I'm talking about how debt works when it comes to taxes. Okay, so take this for what it's worth. You made $25,000 this year in your business. Nice. Now you want to go out and ball out with a G-Wagon, but you don't have $100,000 to buy this G-Wagon with cash. So what do? You put down $20,000 to buy this $100,000 G-Wagon, and you finance the other $80,000. Now, you will get that same $80,000 deduction. But how are you going to write off $80,000 of a deduction when you only have $25,000 worth of income? Because now you subtract this $25,000 that you could, now you have $0 of taxable income, but you still have a lot of money left over in this deduction. Well, now you have a loss, because now you get to tell the IRS, okay, I didn't actually have any taxable income. In fact, I had a $55,000 loss in my business because, well, I had to go out and buy this G-Wagon. Now again, this doesn't mean that you have negative $55,000 in your bank account. You still have 5 grand in your bank account because you financed this G-Wagon. So you have $5,000 in your bank account right now. You tell the IRS that you have a $55,000 loss because you get to deduct 80% of the value of this G-Wagon. Now, next year, you might make a little bit more money. Let's assume next year that you made $35,000 in your business. Nice. Well, now you tell the IRS, hey IRS, I made $35,000 in my business this year. But last year, I lost $55,000. So now you deduct this against this, and again, you have $0 of taxable income, because now you had $35,000 of profit, which is in your bank account. This plus this means you have $40,000 in your bank account, but again, $0 worth of taxable income because you get to carry forward this loss. Then the year after that, you get to take the leftover from this loss on your income again. Now you can start to see how some business owners will be able to use debt strategically to carry forward losses against their income. And this can get much bigger when the dollars are bigger too. It doesn't have to be cars, it doesn't have to be planes. You can buy machinery, you can buy other equipment for your business. You could potentially buy real estate strategically. There's other rules with real estate which will now allow you to deduct the value of the asset that you bought from your income, show a loss on taxes even though you have cash in your bank account, even though you're making a profit on paper. You have cash, you're making a profit, but you have a taxable loss. And now you can take this taxable loss, and move it forward every single year as long as the IRS said so, but you can keep moving forward this loss, which means you make a profit, you have more cash in your bank account, but you owe no money in taxes legally. Let me give you another fun example. Let's assume that you made $2 million this year from your business. This is the profit, this is the cash in your bank account. Now, if you just left this money as it is, you don't have any other deductions, you're gonna have a pretty big tax bill because if you have $2 million of income, that's a big tax bill. But now, if you were to go out and buy, let's just say a $20 million plane, well now, what are you gonna do? You're gonna put down $2 million to buy this $20 million plane, and you're gonna finance the other $18 million. So this is $18 million worth of debt. And now the IRS has some special tax provisions on planes, which will allow you to deduct pretty much the entire plane this year. Which means now you get to tell the IRS, hey, I made $2 million minus these deductions, which is this $20 million plane that I just bought, even though you only put down $2 million. So that means you have negative $18 million in taxable income. Now next year, if you made $4 million, you just carry forward this loss. And the year after that, you can carry forward the loss again. And you do that again and again and again. And then maybe you could sell this plane for $20 million. Maybe you sell it for a profit. Maybe you sell it for a little bit of a loss, but you're making money every year and you're paying little to no money in taxes. And this is completely legal. Again, this is why it pays to have a good accountant. Now, this doesn't mean you have to go out and buy a plane. This doesn't mean you have to go out and buy a G-Wagon. There's so many other ways to do this. Just planes and G-Wagons are fun to talk about, but there's so many other ways to do this, which is why you want to make sure you have a good accountant on your side. That way you understand the different deductions that are possible. That way you can actually use them. This is what strategic tax planning is, because tax planning is all about understanding the different ways that you can spend money. That way you can have cash in your bank account and pay little to no money in taxes legally. Now, of course, when it comes to debt, you have to understand debt comes with its own risks. Our economy goes through highs and lows, meaning you have to predict that there are going to be times where your business will also go through highs and lows. And so if you use debt, you have expenses that never go away. And so you have to factor that in there. So don't just go out and take on a whole bunch of debt because, well, you don't want to pay any money in taxes. Understand the risks with that because debt has its own risks. This is where you want to be financially smart, but then you also want to be tax smart. That way you can pay the least amount of money in taxes legally. And it's no surprise that rich people know how to use the tax code to their advantage. I mean, Warren Buffett talks about how he pays a lower tax rate than his secretary, and Donald Trump openly talks about how he doesn't pay any taxes. As an attorney, I can tell you that there's a difference between tax avoiding and tax evading. Tax evading is illegal. You're doing a crime and you will go to jail. Tax avoiding is 100% legal. Now you're using the IRS rulebook as a guideline on what you can do legally to not pay taxes. This is what rich people specialize in. They want to know what the IRS rulebook says, that way they can pay the least amount of taxes legally. The interesting thing is I never grew up learning about any of this. The first time I was exposed to any sort of financial education was when I read Rich Dad Poor Dad by Robert Kiyosaki, and not too long ago I was in Arizona talking with Robert Kiyosaki, and he told me that the reason why he's so rich is because he's in debt.
I save gold. I don't save dollars. I borrow dollars. That's why you want to listen to Dave Ramsey, who's a good friend of mine. Live debt free. I go, why are my friends all billionaires and they're deeply in debt? I don't even need real estate. I use debt. I'm just looking for an excuse for somebody to give me a loan.
Now, handling debt isn't for everybody. It requires a certain level of financial education, it increases your risk, and it requires some expertise in what you're doing. But what many rich people do who have mastered debt and taxes is they follow a system called BBD, which stands for buy, borrow, die. This system allows many rich people to now borrow money and live their life wealthy and pay $0 in taxes legally. So what I want to do today is go over how rich people use debt and taxes to their advantage to make themselves wealthier. That way you can potentially use this to your advantage as well, because the reality is this is how the system works and this is how the tax code works, and you can either learn it and use it or not. But here in this video, I'm going to go over how it all works, that way at least you understand. Wealthy people are not stretching themselves thin and going into debt so they can have a fancy car and wear Gucci and wear Louis Vuitton and go on fancy vacations. They go into debt for one reason and one reason only. It's for income. If it doesn't produce income, they're not going to go in debt to buy it. There are two general ways to do this. You can do this through business, or you can do this through real estate. A third way that sometimes people talk about is through investing their money, but when you invest your money, you're either investing your money in businesses or real estate to take advantage of the debt and tax laws. So I'm just going to focus on the business and real estate side and just understand that investing is incorporated into both of these. The way the tax code is made, it's designed to incentivize people that are producing jobs, producing homes, and producing things for the economy. But if you're just a W-2 employee and all you do is you make money and you spend it, it is going to be extremely difficult, actually impossible for you to take advantage of the system because the tax code is not incentivizing you to really do anything. The tax code incentivizes you to invest and create and produce. It's not incentivizing you to just consume and spend and work. Now, that doesn't mean that you can't take advantage of anything that I'm going to talk about if you're an employee. That just means you're going to have to think a little bit bigger and do some things with your money outside of your job. That way you can take advantage of the system. And what you'll start to realize is if you don't understand the system, then you don't get any of the benefits. Like one of the biggest benefits that people talk about when it comes to home ownership and tax breaks is if you own a home and you have a mortgage, you get a mortgage interest rate deduction, which is great for your taxes and you get to take advantage of the system. But that's one big lie. Rich people and wealthy people don't care about the deduction because it's pennies compared to some of the other breaks that you can get if you understand how the system works. So let me start by talking here on the business side of things. The first thing that you have to understand is that you are taxed on your income. If you make a salary, if you make an income from your job or your business, you are going to be taxed on the income. If you work a job and you make $100,000, you're taxed on the $100,000. If you own a business and you pay yourself a $100,000 salary, you're going to be taxed on the $100,000 salary. But one of the things that you can do is not get paid through your business. So if you don't want to pay any taxes, then you don't want to have any income. Now, at first glance, you're going to say, if I have no income, then I have no money to eat. But that's not exactly correct. What some rich people are able to do is instead of taking out an income is they borrow against the value of their business. So let's assume that you build a business and it's worth $1 million. Well, instead of you taking out a salary of $100,000, you can go and take a loan against the value of your business for $100,000. Now, you still have $100,000 in your pocket, but this debt isn't taxable because you don't actually pay yourself anything. You're borrowing money from the bank, and now you have $100,000 in your pocket just like before, but this is tax-free because this is debt. Now, the thing that you have to remember is this $100,000 that you borrowed from the bank isn't your money. It's money that you're going to have to give back to the bank plus interest. So if you have to pay this money back to the bank at, let's say, 6% interest, what you need to do is you got to make sure that your business is growing by at least, At least 6% a year. Because if your business is growing by 6% or more a year, if your business is growing by 7% a year, then you came out a winner. So you didn't take an income. You don't have to pay any taxes on the $100,000. You borrow this money from the bank tax-free. And if you can grow the business by more than 6%, well, now you're a winner and you didn't have to pay any taxes. Elon Musk is probably the most popular example of this in action because he built Tesla. But while he was building Tesla for a number of years, he never paid himself a salary. So a lot of people were upset because he was worth billions and billions of dollars, but he paid $0 in taxes. The reason why he paid $0 in taxes was because he was paid not in dollars, but in stock options. So he never really got any money in the bank from his company. What he did was he got these stock options saying that he had the ability to buy Tesla shares for about $6 a share. It was something like $6 and some change, and he was given millions of shares. So when the stock price went up to $1,000 a share from $6 a share, he saw a lot of appreciation in the value of his stock options. And considering that he had millions and millions of stock options, he had stock options worth billions of dollars. Now again, this wasn't cash that he had in his personal checking account. This was the value of his investment, of his asset, his stock in Tesla. But instead of actually selling his stock and having this cash come into his bank account from the sale, that would be taxable. What he did was he went to the bank and he told them, hey, I have the stock worth $1 million. Just for example, give me a loan for $100,000. The banks were happy to do that because then the banks would make 6% interest, and now all Elon Musk has to do is make sure that his stock is growing faster than the interest that he's paying, because as long as he keeps doing that, he's coming out on top. He has cash in his pocket to live his life, and he doesn't have to pay a penny in taxes. Larry Ellison, the founder of Oracle, did the exact same thing. He had access to 250 million shares of Oracle, but if he sold those shares, he'd have a big taxable event. So instead of selling his shares and paying a whole bunch of money in taxes, he used the value of his shares to go to the bank and open up a $9.7 billion credit line. And now this is money that he can use to live his life. He's got to pay interest to the bank, but as long as the value of his company, his stock, is growing faster than the interest rate that he's paying, he's a winner. And then after that, they follow what I was talking about in the beginning of this video, which is BBD. Buy, borrow, die. What that means is you can keep doing this again and again and again, and as long as the value of your underlying asset, in this case the stock, the company, keeps growing, you can just do this until you die. Now you get to live your life, you get to have all of the nice things, and you never have to pay a penny in taxes. And then when you die, you pass your shares on to somebody else, and the person who gets your shares, your new company, they get something called stepped up basis, and they don't have to worry about the major tax implications because of the stepped up basis. What that means is, let's assume that you have a company worth $1 million, but your basis, what you bought it for, is $1,000. So in Elon Musk's case, remember, he was getting shares for $6 a share, and then when the Tesla company went up to $1,000 a share, if he sold his stock at $1,000, he would have to pay taxes on his profit, which is the difference between $1,000 and $6, which is $994 per share. So that's a lot of taxable income. So assuming here that you had a basis of $1,000 and now it went up to $1 million, you have almost $1 million in taxable income. So if you were to sell, you'd have a big tax bill. So one of the things that you can do is the buy, borrow, die. And now if you die, your heirs, let's assume it's your kids, get this $1 million asset. And then when they get this $1 million asset, they get stepped up basis. So the IRS assumes that they don't get it for $1,000. The IRS assumes that they bought it for $1 million. And so if your kid now sell this asset for $1 million, they have $0 in taxable income. If they sell it for $1.1 million, then their taxable income is $100,000. So you only have to pay taxes then on any gains above the $1 million, which is what the kids got. Now at this point, if you're thinking, Jaspreet, that's really cool if you were a billionaire like Elon Musk or Larry Ellison, but I don't have a $1 billion or a multi-million dollar business, so I can't take advantage of this. Well, there's some other things that you can do. If you have your own business or you're a side hustler, so now you're not a W-2 employee, you are a contractor, you have your own small business, well, what you have to remember is you only pay taxes on what's left. So you have your income that comes in, and then you pay your expenses, which are your deductions, and this is your taxable income. So what you have to understand is what can fall here into your taxable income. Because a lot of times people ask, is this thing deductible? Is it deductible for me to go on a particular trip? Is it deductible for me to buy a certain item? Well, a better question to ask is, how can it become deductible? Because almost anything can be a tax deduction if you know how to ask the right questions. This is where it pays, literally, to have a good accountant who's a tax advisor who can tell you what's going on and how you can use your money, that way you have less taxable income legally while you can still buy all the things that you want. So, for example, one of the things that's going on until the end of 2022 is the tax code is giving bigger tax breaks for business owners that are eating out at restaurants. So if you go out and you take your employees out to eat, you get a 100% tax break until the end of 2022 as a way to incentivize people going out to eat at restaurants, as a way to help stimulate the economy. So if you have people on your team, or if you are a side hustler, if you're a business owner, you have the opportunity now to get a tax break for eating out at a restaurant. We here at the Minority Mindset Companies went to a hybrid style work office after the pandemic hit, which means that people come in the office when they want. You can work from home whenever you want. But once a week, we do something called Team Day, where the team comes into the office, and every week in this Team Day, we go out to eat at a restaurant. Now, we didn't start doing this because of the tax break that we were gonna get. We did this for fun, but it's kind of a nice bonus that 100% of the money that we're spending at the restaurant is a tax break on my taxes. Let me give you another example. If you're watching this video when it goes live, I will be on a 2-month business trip travel where I'll be staying in San Diego with my business partner, working on a whole bunch of different things. I'll be meeting with a bunch of different business owners out there, doing some interviews, meeting some influencers. So doing work out of San Diego, I'll be living in an Airbnb with my business partner. And I should also mention that my business partner is my wife. This is a tax deduction and it reduces my taxable income. Now, you might not be able to reduce 100% of every dollar that you spend, but if you have a good tax advisor, if you have a good tax accountant, they'll be able to help guide you and show you how you can spend money and have that money be a tax deduction. Now, the money has to be spent in a way that benefits your business, but if you are a true entrepreneur, a business owner, a side hustler, guess what? Your life a lot of times is your business. And so you have to understand how you can use this system to your advantage. That way you can legally pay less money in taxes. Because remember, the IRS is just a rule book. You want to make sure you understand how the rule book works, that way you can use it to your advantage. Now, what if you're completely not an entrepreneur? You hate the idea of starting your own business, you hate the idea of being a side hustler, you love the security of your job, and you can't leave that. You have to just work a job, and now what do you do to get some of these benefits? Now, obviously, one of the things that you could do is invest your money yourself, because when you invest your money, you get natural tax breaks, because investment income is a lower taxed income than your job income. But the second thing that you can do is through real estate. Let me show you one of the reasons why rich people love investing in real estate. So let's assume that you go out and you buy a property for $1 million, and this property generates cash flow of $70,000 a year. That means you buy this property for $1 million, then this property generates rent, because let's say it's an apartment complex, people pay rent, now you have to pay all your expenses, you have to pay taxes, you have to pay insurance, you have to pay your management people, you have to pay your maintenance fees. After all those expenses, you are left with $70,000 in the bank. Now, chances are you probably don't have $1 million in your checking account to go and buy this property cash, so you'll have to go to the bank and get some debt to buy this property. Now, what you're doing is you're using debt to buy income. And in order to do that, you're gonna have to come to the closing table with some cash. So the bank might give you $800,000, and you'll have to bring about $200,000 to the closing table. Now, if you don't have all $200,000 yourself, this is where you'd have to go out and network with some people and go out and raise this $200,000. So you have $200,000 of equity, $800,000 of debt. Now, what happens is you're making $70,000 a year of profit, but you still have to pay your debt. So you'll have to pay about $52,000 in debt, which would leave you with $18,000 of net income after your debt payments. So now this $18,000 is left in the bank account after all of your expenses are paid, but you don't have to pay taxes on all $18,000 because you invested in real estate. Real estate offers some of the most favorable tax breaks that our tax code has to offer, because they offer something called the depreciation deduction, which says that every single year you get to depreciate the value of the building on your real estate. So let's assume that 20% of the cost, so $200,000, is the cost of the land of what you bought, and the other 80%, the $800,000, is for the actual building, the actual apartments on the property. Well, if it's an apartment complex, you get to deduct 1/39th of that amount, so 1/39th of $800,000 every single year over the next 39 years. That means you will get to take a deduction of right around $20,500 every year for 39 years, which means you have a loss of $2,500. Now, you gotta understand what this means. You have $18,000 in your bank account. This is money that you can spend, but you get to go around and tell the IRS, hey, I made $18,000, but I get to take this tax break, this tax deduction for $20,500. So you have a tax loss of $2,500, which means you owe $0 in taxes, because remember, you only pay taxes on income, and to the IRS, you have no income. Actually, you have a loss while you still have money in the bank to spend. But this is where things get even more interesting, because before, when you bought this property, you had a profit of $70,000. But now what a lot of real estate investors will do is they'll start doing some more renovations on the property. They're gonna work to improve the property, that way they can increase the amount of money that they're making. So maybe now you start adding in some stainless steel appliances. You update the kitchens, you update the bathrooms. That way now you can charge a little bit more money for your rent, because you're providing more value for your tenants. And so now over the next few years, you're able to drive up your income from $70,000 a year to $100,000 a year. Now you can go back to the bank and say, hey, we drove up our profits. Before, we were only making $70,000 a year. That's when we were worth $1 million. But now we are making $100,000 a year. Now the bank is going to say, oh yeah, you've definitely increased the value of your property, so we don't think you're worth $1 million anymore. We think that your apartment complex is worth $1.5 million. So now what you get to do is you get to refinance against this property. So if we do the same thing and you pull out some cash, let's assume that you pull out $1.1 million. Now what you get to do is you take $800,000 from here, you pay off the old loan. You take $200,000 from here, you pay off all the investors. And that still leaves $100,000 that now you can put in your pocket for putting this deal together. And remember, this is tax-free because this is debt. This isn't income.
So you get to pull out $100,000 for yourself, even if you didn't put in a single penny if you brought in other investors. But a lot of times you're going to have some skin in the game. You're going to have to put in some of your own cash. But this $100,000 now is yours. Now, of course, along with that, your debt payments are going to go up as well. So now you're making $100,000 a year, and your debt payments are going to go up to around $72,000 a year, which still nets you $28,000 a year in positive cash flow after paying your debt. But now you own the property free and clear. You don't have any of your own money in the property. Your investors don't have any money in the property. It's just the bank's money. And so this profit is your return on your $0 invested in the property. You have no cash in the deal, but you're still making $28,000 a year. This is why it's called an infinite return. And you can keep doing this again and again and again as long as the value of the asset is strong. Now, it wouldn't be right for me to not talk about any of the risks, because one of the reasons why people get in so much trouble trying to do this is they either over leverage or they don't understand the asset. They don't know what they're doing, because at the end of the day, the value of you being able to do this depends on the value of your property, and the value of your property is going to depend on how much money you're making. So you need to know how to manage the property. You need to know how to get the property leased. You need to know how to give good value to your tenants, and you need to know how to keep generating these types of profits. If you don't know what you're doing, if you get greedy, you start over leveraging, well, then you're the first one that's going to get foreclosed on when property values go down and the bank wants their money. But this is one of the ways that real estate investors are able to leverage debt to pay no money in taxes while growing their wealth at the exact same time. This is why I said in the beginning of this video that one of the biggest lies that we're told is that the mortgage deduction that you get when you buy a home to live in is a big tax break for the average American. Now, what that really is not a tax break, it's a tax incentive. Because when you get a home, you buy $1 million home or a $500,000 home or a $100,000 home, and you get a mortgage on it, you're going to have to pay money in interest. So assuming you pay $10,000 a year in interest to the bank, you still have to have an income to pay for that interest in order to get this tax incentive. Now, in order to get that income, you're going to have to go out and do something else. Versus if you are a real estate investor, remember what I said in the beginning, you're buying income. That's why wealthy people go into debt. They're going into debt to buy income from the asset, and the asset that you're buying is what's paying for your mortgage and putting some money in your pocket. It's cash flowing. When we're talking about your home, you have to have an income. You have to go to work every single day to pay off the mortgage to get this tax incentive, not even the tax break or the tax credit. You're getting a little tax deduction from the interest that you have to pay, but you still have to work to get the money to pay it, versus here, the asset's doing all the work for you. Then it just goes back to the buy, borrow, die. You keep doing this again and again and again, and then you can do this until you die, and then when you die, you pass it on to your heirs, and then when your heirs get it, they get the stepped up basis, so they get a tax break when they go on to sell the asset. Now, I know all of this might seem really complicated. You don't have to go in and start buying $1 million deals right off of the bat. You don't have to go in and leverage yourself up to the eyeballs. There's a lot of ways to do this, and there's ways to do this without taking on a whole bunch of risk, just depending on what your risk tolerance is and what you're okay with and how fast you want to see your growth. But it all starts with your financial education, and it all starts with one deal. Like, I started my first real estate deal with a small 1,000 square foot condo, and it was a major headache because I had no idea what I was doing. But now real estate investing is a lot easier because I have the right people and I know what I'm doing, which makes the process so much more simpler and so much more passive. It's not how much money you make that's important. It's how much money you keep after taxes. The largest expense for many Americans is, well, taxes. And as an attorney, who's not your attorney, what I can tell you is that our IRS tax code is a rule book. It's a rule book that's over 2,000 pages long, going over what you should be paying taxes on and not be paying taxes on. And your goal is to pay the least amount of money in taxes legally. Not all income is taxed the same in the eyes of the IRS. That's why two people who earn the same amount of money can keep two completely different amounts of money after taxes because they're taxed differently, and two people can spend the same amounts of money while one person can get much bigger tax write-offs than the other, which is why it is very important that, especially if you are creating your own income, you're investing in real estate or doing other things like that, it is very important for you to have a good and smart accountant on your side. And even if you don't, well, an accountant can help you strategize your tax deductions and tax write-offs. That way you can maximize your deductions while also making sure you're following the rules. But what I want to do today is go over 7 different things that you need to know, that way you can pay less money in taxes legally. And of course, if you have specific questions, please talk to a licensed advisor in your area. Number 1 is understanding that you're not taxed on how much money you make. You're taxed on your net
taxable income. If you invested your money into the stock market and one stock that you invested in made you a $10,000 profit that you sold, and then another stock that you invested in has a running $5,000 loss, well, if you sell this investment, you have $10,000 worth of taxable income. Now, if you also sell this investment for a $5,000 loss, this brings your net taxable income down from $10,000 to negative $5,000 because you're not taxed on how much money you earn, you're taxed on your net taxable income. Now, of course, you have to actually sell this investment and realize the loss to net this out. But if you have losses, you can use some of your losses to negate some of your wins when it comes to investing. Now, this is where the natural next question is, okay, if I had this loss in my stock market investments, can I use this loss to offset some of my taxable income from my job? And the answer is, well, it kind of depends. The IRS generally likes to compare apples to apples. And so what that means is first they're going to categorize your income because like what I was saying earlier, not all income is treated the same. If you invest in something, whether it's stocks or real estate, and you hold on to it for longer than a year and then you sell, this is called long-term gains or long-term losses. If you hold on to an investment and you sell it in less than a year, this is called a short-term gain if you make a profit, or a short-term loss. The money you make from a job is called your ordinary income, otherwise known as your earned income. So now, if you have long-term gains and long-term losses, you invest in the stock market, you hold on to your investments for longer than a year, and some of your investments make money and some of your investments lose money, you can net those out right here in your long-term category. If you have other short-term investments where you invest your money, say in the stock market again, and you sell these in less than a year, well then you can negate your gains and losses in your short-term investments here, and then you're going to have your ordinary taxable income, which is now the money you make from your job. You're going to pay taxes on the money you make from your job. This is generally going to be treated in its own lane, but there are some exceptions to this rule. The general rule is that you can deduct up to $3,000 worth of capital losses against other types of income if you are married. If you are single, filing a single tax return, then it's $1,500. So if you have a $1,500 short-term loss, you can deduct up to $3,000 worth of capital losses on your investments against your ordinary income. If you have an even bigger loss, well then you can carry that forward to future years. The second thing that you can do is maximize tax-deferred accounts. This might be something like a 401k or an IRA or a SEP IRA or an HSA. 401ks along with 403bs and IRAs are tax-deferred retirement accounts, meaning they are investment accounts that you can put your money into where you can kind of grow your money tax-free. Now there are some rules and restrictions with this, the whole idea being if you use a traditional 401k or a traditional IRA, you can invest your money into these accounts tax-free, meaning when you put your money in, you don't have to pay taxes on the income. So if you take $5,000 from your income and you put this money into your traditional 401k or your traditional IRA, you don't have to pay any taxes on that $5,000 today. That $5,000 can then grow over the course of your career, and then when you're ready to retire and you pull your money out, that's when you'll pay taxes on a traditional 401k or a traditional IRA. Now, if you use a Roth 401k or a Roth IRA, now you're going to pay taxes when you put your money in. So if you take that $5,000 and you put it into your Roth IRA or a Roth 401k, you're going to pay taxes on that $5,000 today, and then you'll have the after-tax dollars actually being invested. But now your money can grow tax-free, and then when you pull your money out, you can generally pull your money out tax-free as well. If you are self-employed or you have your own business, now you can use something called a SEP IRA, which is a little bit different than a regular IRA because your limits of how much money you can invest are a little bit different. With a SEP IRA, you can invest up to 25% of your net earnings from your business up to $66,000. Essentially, that means you can take a big chunk of your profits from your business, put it to work in this investment fund, and not have to pay any taxes on this money that you earn today, and then you can grow that money tax-free, and then when you pull your cash out, that's when you'll pay taxes. After that, you also have the option to use an HSA, which is a health savings account. The way that HSAs work is you can put a little bit of money aside tax-free into this account, which then you can use to pay for things like deductibles or co-pays or some other qualified medical expenses that you have to pay out of pocket. So now you can essentially pay for these expenses tax-free if you put this money into an HSA. Now the caveat here with the HSA is you have to have a high deductible with your health insurance in order to qualify to have an HSA. That means you have to have a high deductible health plan or HDHP, and in 2023 the minimum deductible you have to have on your health insurance to qualify for an HSA is $1,500 for an individual or $3,000 as a family. The third thing that you can do is take advantage of the new clean energy tax credits. In 2022, President Biden signed the Inflation Reduction Act, and one of the provisions in the Inflation Reduction Act was that if you spend money to make your home more energy efficient, you can get a tax credit for that. This tax credit is available from now until 2032, and it gives you a 30% tax credit on energy efficient improvements on your home. Now, of course, this includes things like solar panels, but it also includes things like replacing your exterior windows, replacing your exterior door, improving your AC, and improving your furnace. Now, there are some rules associated with this, so definitely talk to an accountant or at least read the rules before you go and actually implement this, but this is a way now for you to improve your home and get a tax credit while you're doing that. Number 4 is really understand that not all income is taxed the same way. According to the IRS, there are 3 general categories of income. You have earned income, otherwise known as ordinary income, you have a portfolio income, and then you have passive income. Your earned income or ordinary income, this is the money you make from your job. This is your W-2 income. Your portfolio income, this is the money you make from things like your stock market investments. If you hold on to a stock and you buy a stock and you sell it for a profit, that is your portfolio income. Passive income would be something like your rental property income. If you own a rental property and it's paying you with cash flow, that is your passive income. Do you want to know which of these 3 different types of income comes with the highest tax rates and the lowest tax write-offs? Well, it is your ordinary earned income. The money you make from your job comes with the highest tax rates and the lowest tax write-offs. When you go and invest your money in something like the stock market and you hold on to this for the long term, well, now you qualify for long-term capital gains. And at the time of recording this video, the top tax rate for long-term capital gains income is 20%. While at the same time, the top tax rate for now your earned income is closer to 40%. So if you make a lot of money, and you make a lot of money from your job versus a lot of money from your investments, well, you can pay much less money in taxes on your investment income than your earned income, just because that's what the tax code says. What does this mean? Well, it goes back to the importance of being financially educated, because now if you are investing your money, because not everybody can be a business owner, not everybody's going to go out and invest in real estate, but everybody can be an investor. If you start investing your money, well, now you can take advantage of some of these lower tax rates and you're building wealth while you're doing it. Number 5 is maximize your deductions, especially if you have your own income. So if you're self-employed, or if you have your own business, or if you're investing in real estate and you're creating your own income, now you can definitely try to maximize your own expenses and write-offs. Now, if you don't have your own income, this is where you want to make sure you at least maximize the standard deduction. See, the way that your taxable income is calculated is you make money, whether it's from your job or your business, you take your deductions, and then this is now your taxable income. If you don't have a lot of write-offs, you can at least maximize your standard deduction. This is what everybody can qualify for. But if you create your own income, if you're self-employed, or if you have your own business, well, now the question is, how can you maximize these deductions in a way that will give you value for your business and maybe some value for your life as well? 2022 was my biggest year for travel really ever up until now. And in 2022, I spent a lot of time in Airbnbs, a lot of time on planes, a lot of times in hotels. And I had to spend a lot of time in different parts of the country. Like, I spent maybe 2 months or so in San Diego. I spent about a month and a half in Manhattan. And when I went, I lived there with my business partner. So now me and my business partner are living in an Airbnb. We had to go fly out to these places, and then I had to go and work there. I had to eat at restaurants, I had to meet with people and do a lot of business there because I went there for business. But along the way, I also got to spend time in San Diego and Manhattan, which are beautiful cities. Now, I should also clarify that my business partner is my wife. And so now me and my wife got to go to these places like San Diego, and it was a tax deduction. Yes, I was there for business. I was meeting a lot of people. I was doing a lot of interviews. I was working with a lot of people. I was there for work. But the expense to go there and live there now became a tax write-off because, well, I had to go there for work. This was a deduction. Same with meals. In 2022, there was a 100% meals deduction because we were just coming out of the pandemic. which meant if you went out and ate at a restaurant and you had a business meeting, if you were eating with your employees, if you were eating with business partners, if you're meeting with other clients, well, now these meals that you're eating at these restaurants are a 100% write-off. Now, it's still a write-off, but not a 100% write-off. Another popular deduction right now is the Section 179 deduction, which is a heavy vehicle deduction. Essentially what it says is that if you need to buy a heavy vehicle for your business, well, then you can write off a big chunk of that vehicle right now. Like in 2022, my accountant called me and asked me, Jaspreet, what are your thoughts about a G-Wagon? And I was like, well, they're nice cars. What do you mean? He's like, I think you should buy a G-Wagon. Like, why are you saying that? And he said, well, because we have the Section 179 deduction, which says that if you go out and buy a heavy vehicle, like a G-Wagon, then you can write off a big chunk of the vehicle over your taxable income. So you can reduce your taxable income because now you have a G-Wagon. And I was like, well, I don't really need a G-Wagon. I don't really want a G-Wagon. I don't know if I should do that. And he said, look, you are an influencer. You have this brand on social media. And because you do, well, then you can justify to the IRS that you need a G-Wagon to justify this lifestyle and this influencer brand. Now, I didn't go out and buy a G-Wagon because for me, I don't want to go out and just spend $1 to save 40 cents on taxes. I'd rather use that money in a place that's going to give me a bigger return on my business. But you saw a lot of people going out buying Hummers and pickup trucks and heavy trucks because now they wanted to capitalize on this Section 179 deduction. I'm going to talk about real estate even more in just a minute, but another deduction that's been very popular amongst real estate people is travel deductions. Because now if you go fly to Florida, or you fly to Hawaii, and you're going there to look at some real estate, even if you don't buy any, well, now you're going there with the intention of looking at real estate. Maybe with a real estate broker. Maybe you look at some properties. Well, now if you do that, if you go there with the intention to look at real estate, well, now that trip, that little vacation that you had to Florida or Hawaii, is now a tax write-off because you're going there for business purposes. Yeah, maybe you have to go and eat at some nice restaurants. Maybe you have to play golf there while you're on this business trip. But if you're going there for business purposes, now the trip can be a tax write-off. But again, this is where you have to make sure you have a good licensed accountant on your side, because this person will now make sure what you're doing is in line with what the rule book says, and they will make sure that you stay out of trouble, because you don't want to now press the line and then get audited and then have to pay a whole bunch of money in fees and fines. So make sure you do it the right way. The sixth thing that you can do is use debt strategically. Now I'm going to talk about this on a big scale, then kind of talk about it on a smaller scale. But a fun kind of example of this is in the terms of buying a plane. Let's assume now that you run a business and your business made $10 million of profit, so you're making a lot of money. You have $10 million in the bank account, and that means you're going to have a big tax bill associated with that. Well, if you go out and you buy this $20 million plane, that is supposed to be a plane, this plane costs $20 million. Well, you don't have $20 million to go out and buy this plane, but what you can do is you can finance this plane. You can go out and put down $2 million to buy the plane and then finance the other $18 million. So you got $18 million worth of debt. You put down $2 million. Now you own this plane and your bank account has $8 million. Well, now what you can tell the IRS is, yeah, I made $10 million. We only have $8 million in the bank account, but I bought this $20 million plane. So now you can take a $20 million write-off on your taxes. So now you tell the IRS, my taxable income is negative $12 million because you financed the plane. Now you have a plane, you have $8 million in the bank, and you have $0 of your tax bill. Then next year, if you make another, say, $10 million, well, now you can take this negative $12 million and use it to negate these taxes as well. And then you can tell the IRS, hey, I made another $10 million. I have this $12 million loss from the previous year. And now you show that, well, I have a negative $2 million taxable income again. And then you can carry this $2 million loss into the next year as well. And now you're going to use your income to, well, pay down your payments on this plane. Of course, anytime you take on more debt, it comes with more risk. But this is where now you can see how if you use debt strategically, it is a way for you to also limit your taxes. How else do people do this without buying planes? Well, you've seen people do the same thing with cars. You can do this with business machinery. The key here is you want to make sure that you're not over leveraging yourself to really run into financial danger, where now you're trying to finance all these things to limit your taxes, but now you're on the verge of going bankrupt. So again, don't just spend money with the goal goal of spending $1 to save 40 cents. Spend money strategically in a way that's going to help you increase how much money you're making, and if you can get a tax write-off for that, even better. But don't get into the habit of spending $1 to save 40 cents because you're still losing 60 cents along the way. And then finally, number 7 is invest in real estate, because now you can generate cash flow. You own a hard asset, something that you can see, feel, and touch, and you get the tax breaks that real estate has to offer. I know a lot of people who are doctors, and a very common question that I get from all of my doctor friends, especially when they start working, they start making the big bucks, is, man, I'm paying a lot of money in taxes. Is there anything that I can do? And one thing that I always recommend is go out and invest in real estate, because now you'll be working to build wealth, you own a hard asset, and you can also benefit from some of the tax breaks as well. So let's assume now that you went out and you bought this property. Let's assume it's $1 million. You could do the same with a $100,000 property. The same concepts apply, but you buy this property for $1 million. And this property, let's assume that it generates $50,000 a year of profit from cash flow. So this is a 5% return, $50,000 worth of profit. Well, now not all the income is going to be your taxable income, because now you also have to take out your other deductions. So we already took out the deductions for the building. That's how you got this $50,000 worth of profit, because maybe you generated $200,000 of revenue, but then you have to pay for your property manager, you have to pay for your water bill, you have to pay for the utilities, you have to pay for the maintenance, which brought you down to $50,000. Rough numbers. Now, out of this $50,000, you have to pay for your other business operating expenses. Maybe you have to have a cell phone to run the business. Maybe you need a laptop to run the business. Maybe you need your truck to run the business. Maybe you have to pay for gas to run the business. Maybe you have some meals for the business. So now you can write down some of these expenses, which, let's just assume your business expenses bring you down to $40,000 worth of net income. The next thing that you can do is you get to tell the IRS, hey, this property that I bought is 1 year older, so I deserve a write-off for that. That is called the depreciation deduction, where now you depreciate the value of the building. So now this is where the first thing you have to do is you have to separate the value of the land from the building. So let's assume that when you bought this $1 million property, $200,000 was the value of the land and $800,000 was the value of the building. Well, now you can write off a piece of this $800,000 every year until you write off the entire building from your taxable income. Let me show you. If you invest your money into a single family home, then you will get to write off 1/27.5 of the value of the building each year over 27.5 years. If you now buy a commercial building like this one is, then you get to write off 1/39 of the value of the building. So now we know that the value of this building is $800,000. You take the $800,000, you divide it by 89, which is just over $20,000, which means that now you get to take an additional $20,000 write-off just because now your building is 1 year older. This is what's called a paper deduction. You have $40,000 in your bank account, even though this property made you $50,000, then you had your other operating expenses. So now you made $40,000. You take this $20,000 depreciation deduction, which is only on paper, and then you tell the IRS, hey, I only had $20,000 worth of taxable income. Now you have less taxable income, which means a lower tax bracket, which means lower tax rates, which means less money that you pay in taxes. Now, again, you have $40,000 in your bank after paying for all these expenses, and you're only paying taxes on the $20,000. Again, this is why you want to make sure that you talk to a licensed and professional accountant in your area, because there's a lot of rules and a lot of regulations, especially when it comes to real estate investing, and you want somebody who is a professional to guide you, because you want to stay away from the red flags and make sure you follow what the rules are. There are two things that rich people are good at. Rich people know how to make money, and rich people know how to keep that money, aka how not to give their money to the IRS in taxes. NBC News says that the richest Americans pay almost no income taxes. Motley Fool talks about how Warren Buffett, one of the wealthiest investors in the world, pays a lower tax rate than his secretary. CNN covered how Donald Trump paid no money in taxes, and then CNBC covered how Trump said that he is smart for not paying taxes. I don't know about you, but I don't particularly enjoy paying taxes either. Like when I think of my favorite things to do, like hiking and working out and eating some really good guacamole, I don't see paying taxes anywhere on that list. And if you enjoy paying taxes and you feel like you should be paying more money in taxes, then by all means, please go and do that. I mean, you can just go onto the Treasury website and you can donate some more of your money to the Treasury Department. That way, if you're not paying enough money in taxes, you can just donate this extra money to the government and the IRS. I'm an attorney. I'm not your attorney, but what I want to do today is I want to go over 7 ways that you can legally, keyword, legally pay less money in taxes and maybe even not pay any money in taxes. That way you can do what rich people do and keep more money in your pocket. So let's start with number 1. But before we jump into that, I need you to do me a quick favor and smash the thumbs up button below. The first thing you can do to no longer pay so much money in taxes is to stop earning money. This is actually what wealthy people do. See, the IRS taxes you based off of how much money you earn. And so if you can show the IRS that you didn't earn any money, well, then they can't tax you because you didn't earn any money. If you only have one stream of income from your job, this one's going to be harder for you to implement right now, because what wealthy people do is they show the IRS that they didn't earn any money. What they do is they make money from their investments and their assets, but they don't actually earn any money themselves, because when you earn money from your job, that money is automatically taxed. If you own a business that makes $100,000, you don't pay taxes on how much money you make, you pay taxes on how much money you keep. So if you make $100,000 and then you spend all $100,000, well, you only have $0 worth of taxable income because you made $100,000 and you spent $100,000. A couple of years ago, my accountant calls me up and he says, Jaspreet, we have a problem. You have a big tax bill coming unless you can go out and spend more money. So I had to figure out how I could spend $300,000 in the most effective way possible in my business. That way I'd have a smaller tax bill at the end of the year. Now, if you have a business, you don't want to just spend the money to spend it, because then that's just like throwing the money in the garbage. Yeah, you'd have to pay some of that money in taxes, but it'd be better to spend some of the money in taxes and keep the rest of it than just taking all of that money and throwing it in the garbage. So now what you're trying to do is you're trying to figure out how do you take this money, spend it, but grow the business. That way now your business is worth more money and it's going to make more money in the future. That way you don't have to spend that money in taxes, because if you don't spend that money, then half of it is going to go to the IRS. But if you can spend that money and make more money in the future, well, now you're using that money to invest in yourself and make more money instead of giving it to the IRS. So I spent it on things like consultants and classes and advertising and marketing. That way now I'm spending the money. That way I don't have to pay as much money in taxes, but I'm spending it in a way that's going to benefit the business in the long run. That way I can make more money in the long run. And this is the same reason why you see so many YouTubers making so many videos at the end of the year, because they're trying to capitalize on all the advertising revenue that companies are spending. Because at the end of the year, October, November, and December, this is when companies are looking at their books saying, oh my God, we have a big tax bill due. Let's spend as much money as we can in advertising and marketing. That way we don't have to pay so much money in taxes. That means they're paying more money to YouTube to spend on advertising, which means that YouTubers are going to make more money per video in October, November, and December, because you have so many advertisers that are spending money on advertisements. So YouTubers are trying to capitalize on that and make as much money as possible towards the end of the year. And then comes January, February, and March, and now all these companies run out of money and they're not spending any money on advertisements, and now YouTubers are struggling to make any money in January, February, and March. The second way that you can avoid, not evade, but legally avoid paying taxes is by using debt strategically. Elon Musk really demonstrated how this works back in 2021, because he ran a Twitter poll to his followers asking if he should sell his stock. Now, while that seemed like a harmless tweet, he actually had a hidden agenda behind that tweet. Elon Musk doesn't pay any taxes. And the reason why he doesn't pay any taxes is because of what I said in number 1. He doesn't earn any money. He doesn't take a salary out of his company, and because he doesn't earn any money, he doesn't have to pay any taxes, even though he's one of the wealthiest people in the world. Well, back in 2012, Elon Musk was awarded something like 22 million stock options for Tesla stock that he would receive in 2021. When he received these Tesla stock options in 2021, that was the first time that he earned money in years, and now he had to pay taxes on the money that he earned, but he didn't have any money to pay these taxes. That's why he ran this tweet poll, because if he sold his stock, now he'd have some income that he could use to now go out and pay his taxes. At this point, you might be wondering, if he's one of the wealthiest people in the world who doesn't have any cash in his bank account, how does he afford to eat and pay his mortgage? Thanks to the help of strategic debt. Elon Musk is, not surprisingly, one of the largest shareholders of Tesla. And so when he starts getting his options or shares of of Tesla at $6 a share and the price of Tesla goes up to $1,000 a share, he has a lot of money on paper because his share prices have gone up from $6 to $1,000. Now, he doesn't actually get that money in his bank account unless he sells these shares, but if he sells these shares, then he has to pay taxes on these shares. So what he does instead is he borrows against these shares. He takes out debt. If he has $1 million worth of Tesla stock, he can go to the bank and say, hey, how about you give me a loan for $500,000 and you can use my Tesla stock as collateral. He's essentially refinancing out of his Tesla stock. So now what happens is he has cash in his hand, which is debt, and now all he has to do is pay some money back plus interest. Now this works great, especially when you're in an environment with such low interest rates, because now he can borrow money at 3, 4, 5% a year while his stock can grow by 10% a year. So he's making a profit by borrowing this debt, and he gets to borrow the debt tax-free. If you go out and borrow $250,000 to buy a home, you don't have to pay taxes on the $250,000 that you get from the bank. And if you go out and you refinance another $500,000 out of your home, you put $500,000 into your bank account. But again, you don't have to pay taxes on the debt that you get because this is money that you have to pay back. It's not income that you're getting. So when Elon Musk takes debt out against his Tesla shares, he gets this cash into his pocket debt-free. He can pay some of the money back and interest, but the value of his stock keeps going up, so he can just borrow more if he needs more money. This is a strategy that a lot of wealthy people use, where you own assets and then the value of your assets go up. When they go up, now you can borrow against your assets. You take this debt, which is now tax-free in your pocket, and you can live off of this money. You can spend this money. You can live your life. And now you have money in your pocket, tax-free to spend. When I sat down with Robert Kiyosaki, the author of Rich Dad, Poor Dad, this is the strategy that he says that he used to become a billionaire on paper, and it is a strategy that made him wealthy. Take a look.
The reason I pay no taxes is because I borrow money. I'm a debtor. The only way the economy, and check this out. I mean, all you communists out there, check this stuff out. I am a billionaire in debt. You know why? Because I get tax breaks for borrowing money. And the reason I am so rich is because I'm in debt. And my friend Dave Ramsey says, live debt free. I'm going, well, you're an idiot. I mean, he's my friend, but I say, Dave, I like debt. He says, I know, but most people can't handle debt. I said, I agree. But that's why there's no financial education in schools, because if you knew how to handle debt, you wouldn't save that crappy dollar you have in your hand. I'd rather borrow the money tax-free.
Now, I wouldn't feel right going to the third point without giving you a little bit of a warning, because taking on more debt does come with more risk. I mean, anytime you take on debt, it has risk, but if you over leverage, then it comes with more risk, because we've seen that if you over leverage on anything, whether it's stocks or real estate, and then you start to see the value of the asset go down, now you're underwater and now you can really struggle. So if you do go down this route of using debt as a way to live tax-free, just make sure that you're being cautious, that you're not over leveraged, and you know what you're doing. The third thing that you can do to not pay taxes is to maximize your deductions. And one of the easiest ways to do that is by hiring an accountant, because your accountant's job is to do one thing: find as many tax deductions as possible. That way you can pay less money in taxes. If you own your own business, or you have a side hustle, or you're an independent contractor, now you have opened up the doors of tax deduction possibilities. When you only earn your money from your job, your financial statement looks something like this. You earn money, and then you pay taxes, and then you can spend whatever is left. But if you own a business, or if you're a side hustler, or you're an independent contractor, now you have a different financial statement, because now you earn just like before, but then you can spend your money, and then you only pay taxes on whatever is left. Things switch because of how you earn your money, because the government and the IRS want to incentivize you to invest in your growth, and they incentivize you to go out and take a risk and start a side hustle and start a business because, well, it's risky, and so you get rewarded with less taxes. For example, I use my cell phone and my computer in business. So when I go out and I buy a cell phone and my computer, this is a business expense because I need to use it in my business, so I get to deduct it against my taxes. My team and I went out for lunch today. That was another tax deduction. I just showed you an interview clip that I made with Robert Kiyosaki. Well, in order for me to make that clip, I had to fly out to Scottsdale, Arizona, the beautiful Arizona. In order to record that, I needed to have a hotel room, I needed to have food, I needed to have a car. All of those things were a tax deduction, and along with that, I got a trip to Arizona. See, I make money and then I get to spend money on things like my cell phone, my laptop, my food, and my trips. And then after what's left, that's what I pay taxes on. I spend my money and then I pay taxes, while most people earn money and then they pay their taxes, and then that's when they go out and spend money on their cell phone or their computer or their food or their trips. Now, of course, all of these tax deductions have to be used in my business. They have to be used to help grow the business, and you don't always get to deduct 100% of every dollar that you spend, which is why you want to make sure you speak to a tax professional before you go out and do any of this. But you can see how the tax code incentivizes you to go out and start your own side hustle and start your own business, because you get the incentive with the tax code, and this even goes to your car. I hired a new accountant recently, and he calls me up last week and he says, "Jaspreet, what do you think about G-Wagons?" I'm like, "They're nice. Why?" He says, "Well, I think you should consider buying a G-Wagon because I think that we can get you a good tax deduction on your G-Wagon." Section 179 says that you can go out and buy business equipment and deduct it against your taxes. But the reason why this is so different and unique right now in 2022 is that there's a special provision that says that until January 1st, 2023, if you go out and you buy a heavy car for your business that weighs over 6,000 pounds, you can deduct 100% of that purchase price against your taxes this year. Typically, the way it works with heavy machinery is you have to deduct a piece of it every single year for a number of years. So if you go out and you bought a $30,000 car, well, you wouldn't be able to deduct all $30,000 this year. You could only deduct a small piece of that, and then you deduct it a little bit next year, and the year after that, and the year after that. But now, Section 179 says that until the end of 2022, if you go out and buy a heavy car, you can deduct all of it against your taxes. Now, there are some limits and exceptions to this, so again, talk to a tax professional before you go out and do anything. But what my accountant said is that, yeah, you don't need a G-Wagon to run your business, but what we could potentially claim is that because you have a lifestyle brand, it goes with a lifestyle, so there is a claim that we can make that you as an influencer need a G-Wagon to help you run your personal brand. Now, personally, I'm not going to go out and buy a G-Wagon just for the tax purposes because, again, like I said before, I don't want to just spend my money to spend it. If I'm going to spend my money, I want to do it in a way that's actually going to earn me a return and help me build my business and help the business earn more money over the long term. But these are things that you're seeing people do, and these are potential claims and deductions that you can make if you follow this system. But the only way that you can do that is, again, if you own a business, or if you're a side hustler, or if you're an independent contractor. The fourth thing that you can do is you can invest more aggressively. Now, I've been talking about why you need to invest for so many reasons. You need to invest to build wealth. You should be investing to fight inflation. But now I'm talking about why you need to invest to fight taxes. Investing is something anybody can do regardless of how you earn your money, and it provides a tax break for everybody. You don't need to be a millionaire, a multimillionaire, a 100,000aire in order to start getting tax breaks from investing your money. But what you do have to do is you have to actually invest your money, and you want to make sure you're investing your money the right way. If you go out today and you buy a stock for $100 a share, and then 3 months later it goes up to $200 a share and you sell, well, now you have made some money from your investment, but you're not going to get any tax breaks because you sold your stock within less than a year, and in the IRS's eyes, that's not considered an investment. An investment is something that you hold on to for longer than 1 year, because if you hold on to something for longer than 1 year, now you qualify for something called long-term capital gains rates. Capital gains rates, long-term capital gains rates, are a lower tax rate that you get when you invest your money, and I mean actually invest your money for longer than a year. If you're just trading your money, meaning you're holding investments for less than a year, you don't get those tax breaks. Now, the money that you earn from your investments that you hold on to less than a year, are going to be taxed at the same tax rates that you would have gotten if you earned this money from your job. If you work a job, and let's say you make $40,000 a year from working a job, you're going to have to pay taxes on this money. You're going to have to pay federal taxes, you're going to have to pay state taxes, you're gonna have to pay FICA taxes, and after all these taxes, you'll be left with something around, let's say $32,000, depending on where you live. Some states are gonna tax you more, some states are gonna tax you less, but something around $32,000. This is if you work a job. Now, if you invest your money like I've been talking about, and you earn $40,000 worth of profits. So now you bought a stock, you bought some real estate, you bought an investment, you held on to it for longer than a year, and you sell it and you have a $40,000 profit. Well, now you don't have to pay any long-term capital gains rates because you're under the threshold. $40,000 is zero. And then depending on where you live, you might not have to pay any state taxes. You don't have to pay any FICA taxes, which means at the end of all of this, you are left with $40,000. $40,000 is more than $32,000, and the reason why you get to keep more is because you earned this money from your investments, not from here. If you make $40,000 in your capital gains, long-term capital gains, your tax rate is zero, and the highest tax rate in 2022 on long-term capital gains rates is 20%. So if you make $1 million from your investments, the most you're gonna pay is 20% in taxes. The fifth thing that you can do is you can earn money from real estate investments. If you go out and you buy this home and you keep the numbers round and easy to understand, let's assume that this home costs $100,000. Now again, you're not buying this home to live in yourself, you're buying it as an investment property, so you're gonna rent it out to somebody else. And let's assume that you can rent it out for $1,000 a month. So if you can rent it out for $1,000 a month, that's $12,000 a year in rental income, but you don't get to keep, I don't know what I'm doing here, you don't get to keep all $12,000. You have expenses to pay. So let's assume that a third of this money is going to expenses. This is your taxes, your insurance, your maintenance costs, your management fees. So that costs you 33%. So now you're gonna send in about $4,000 a year in your expenses, which leaves you with $8,000 of profit. Now, if you go out and you get a mortgage to buy this property, that means you're gonna have to finance $80,000, so you're gonna have to pay some of this money back to the bank. So if you borrow $80,000, it's gonna cost you something around $400 or so a month. So $400 or so a month is right around $5,000 a year, which means now you have to subtract your $5,000 a year in your debt costs, which leaves you with $3,000 in your pocket. Now, you're gonna have to tell the IRS that, hey, I made $3,000 of income, and you're gonna have to pay taxes on this $3,000 worth of profit. Except, you get another tax break as a real estate investor. You get to tell the IRS that, hey, my property is a little bit older, and because my property is a little bit older, I deserve a tax break even if the value of your property is going up. So now you will get to tell the IRS in this case that because your property is older, you should get a $3,600 tax deduction. This is only on your taxes, which means that in your tax return, you get to tell the IRS that you made a whole negative $600. So you tell the IRS that you made negative $600 when in actuality, you put $3,000 in your pocket. The technical reason why you get to do that is you get to deduct one for 27.5 years. The reason being because your home goes through wear and tear, and you get to deduct that on your taxes, and you get to deduct this even if the value of your property is going up. So now you made $3,000. Your bank account has $3,000, but you get to deduct this much of your property every single year. In this case, that's $3,600, assuming that $100,000 is just the property. There's no land included because you can't deduct the value of your land. So now you are left on taxes on paper with a negative $600 income. You pay taxes on negative $600, which means your tax bill is zero. And the next time you have to pay taxes, you'll be able to deduct this $600 of loss against that, but you show the IRS that you didn't make any money, but in actuality, you still have money in your pocket and it's completely legal. This depreciation loophole is what allows people like Donald Trump to make a lot of money every single year from their real estate properties, but pay nothing in taxes because you get to deduct the value
of depreciation of the property while you're still earning money. And then if the value of your property goes up to $200,000, what you could do is you can just refinance out. So now you can pull out another $100,000 and now you get this money in your pocket again, tax-free. Remember we talked about earlier, living off of debt? That's again what real estate investors do. When the value of the property goes up, they borrow against it and now you have cash in your pocket tax-free. You can use this cash in your bank to go out and buy another property, create more income, get more tax deductions, and have more money in your pocket while you're paying less money in taxes. Legally. This, as you can see, is why financial education is so important. The average person is not going to be able to take advantage of any of these tax breaks because they don't understand how money works. And if you're thinking, well, what am I supposed to do? All I do is work a job. I don't have the ability to go out and buy some real estate as an investment. I don't have the ability to go out and start a business. Well, what you can do is first get financially educated. That way you can start moving towards the right direction. You don't have to go out and start a business to start getting these tax breaks. You can start a side hustle, which doesn't have to be a ton of work or a ton of time, but it's something that you can start doing, something that you can start implementing to earn some more money and capitalize on some of these tax breaks. And if you want to invest in real estate, it's something that you can do, but you first have to set your mind to it. I mean, if you put a little bit of money aside every single month, you will be able to work towards buying your first rental property. And if you're thinking that you'll never be able to afford a property in your area, well, then you can look in places like the Midwest, because in the Midwest, you can find properties for around $100,000 that will produce great cash flow, but you have to understand the neighborhoods. It takes time, it takes effort, but this is why financial education is so important, because anybody can do it when you have the right mindset and you have the hustle, but you need to know what to do. The sixth thing that you can do involves the home that you live in yourself. If you buy this home right here to live in yourself for $250,000 and you live in there for, let's say, 10 years, and then the value of your home now goes up to $400,000. Well, what you could do is you can sell your home for $400,000 and now you pocket this $150,000, and guess what? This $150,000 that you get from selling the home that you live in is tax free. This is one of the most valuable tax deductions out there for the average person, because if you own a home, you can sell your home and you can profit up to $250,000 if you're an individual, or $500,000 if you are a married person, and this money that you put in your pocket is completely tax free that now you can put in your pocket, you can go out and spend, you can go out and use for a bigger home, or you can use this money to invest in something else. The key for this deduction to work is you have to live in this home as your primary residence for at least 2 years before you sell it. So you can't just buy a home, live in it for 2 months and sell it for a profit and get this tax break. You have to live there for at least 2 years as your primary residence. If you have questions about whether you qualify for this rule or not, again, talk to a tax professional, because there are exclusions, and the last thing that you want to do is to sell your home, you make $100,000 profit, you go and spend this money, and then you find out that you didn't actually qualify for this deduction, and now you have a $30,000 tax bill. So again, talk to a tax professional. And the seventh thing that you can do is sell your real estate investment. So again, let's assume that you bought this property as an investment property for $100,000. You're making your cash flow, you're getting your tax breaks on your deduction, but you're making money every single year, and now a few years go by and the value of your property goes up to, let's just say, $200,000. Now, if you sell your property, you're going to have $100,000 worth of profit that you have to pay taxes on. You don't get that same deduction here that you get with your primary residence, but you have to pay taxes on this $100,000 worth of profit. However, if you take this new $200,000, so you take the $100,000 that you got from the money that you put in, and you take the $100,000 profit, and you go out and you buy a bigger property. This might mean a bigger home, a bigger investment property. If you go out and invest all this money into a real estate investment, a like-kind exchange, well, now you get to defer all of these taxes. You don't have to pay any taxes on this profit, and now you own a bigger property, which means you're going to be making more money. You get a bigger tax deduction, and now you get bigger cash flows. And guess what? Well, then you can double this property to $400,000, and then you do it all over again. And you can do it again and again and again and again. You go from $400,000 to $1 million, $1 million to $2 million, $2 million to $4 million, and you can do this until you die. I don't know why I made dying sound so exciting, but you can do this for your whole life, meaning you can just defer the taxes again and again and again. That way you never have to pay the taxes because you don't touch the principal. You just keep letting the money grow, then you flip it into a bigger property, you let the money grow more, you flip it into another property, and the IRS lets you not pay taxes on it when you do that if you do this exchange, which is called the 1031 exchange. 1031, the 1031 exchange lets you flip real estate property to real estate property without having to pay taxes on the sale. This is one of the biggest tax breaks that wealthy people use to grow and compound their wealth tax-free, because now you can start investing in real estate and you can keep flipping the properties as property values go up. So if you're investing in a good area where property prices are going up, well, now you can flip your properties again and again and again. You're growing your wealth and you're doing it completely tax-free. And while you're doing that, you're also growing the amount of money that you're making every single year, because when you flip into a bigger property, you're getting more rent, and that means you're also getting those bigger tax breaks, the depreciation tax breaks that I was talking about. So you keep increasing the amount of money you're making, and you're increasing the value of your property, and you can do it tax-free if you know what you're doing. Passive income is the idea that you can make money without doing any work, and that whole concept is kind of true, but it's also kind of a lie. There's no true way to create an income that will pay you forever without you having to do anything. There are 3 general ways that I generate cash flow, and some of these are way more passive than others. They are PRR.